Today we will discuss our second half outlook for the economies of Indonesia and Malaysia. Starting off with Indonesia. Economic growth has actually been relatively resilient in the first half of 2024, and this is despite the fact that the economy went through an election period in February. The election outcome was surprisingly resounding, with Prabowo Subianto winning a majority of the votes to become Indonesia's president-elect. He will take over from President Joko Widodo in October of 2024. The key questions for him as president are how much of a follow-through or how much policy continuity will there be from President Jokowi. Now, we've discussed this before, and we do think that there will be some policy continuity in terms of the focus on downstreaming, particularly value adding to the mineral and mining sector, as well as focus on development of the capital city of Nusantara. Beyond that, however, we do think that President Prabowo will remain quite focused on the development goals that he has set for himself. This is particularly in terms of schemes such as the free food scheme, which entails providing breakfast and lunch to school children across Indonesia. The scheme at its peak is expected to cost more than 2% of GDP by 2029. This essentially means that President Prabowo is ready to test Indonesia's long-held stance on fiscal conservatism. There have already been headlines suggesting that he will increase the fiscal deficit beyond the legal limit of 3% of GDP and try and increase public debt as well beyond the legal limit of 60% of GDP. Now, the extent to which he follows through on these promises remains to be seen. However, in our baseline, we do expect that Indonesia's fiscal deficits will hit close to the 3% of GDP legal limit over the next 5 years. This is to say that there will be more fiscal support to growth, and hence we do expect growth to pick up in terms of the GDP growth forecast to 5.1% in 2025 from the cyclical slowdown we've penciled in at 4.8% in 2024. Our cyclical slowdown in 2024 is largely because of fading commodity tailwinds as well as political uncertainty ahead of President Prabowo taking over in October of this year. Nonetheless, given the fact that he has made clear that he will continue to support growth, we expect the medium-term prospects for Indonesia to remain well supported and growth to be between the range of 5 to 5.5% over the next 5 years. Beyond growth, however, there are still some challenges that the policy mix will have to face. On the monetary policy side, BI has been very focused on supporting the currency, the IDR, which has been under significant depreciation pressures versus the US dollar, largely because of interest rate differentials being unfavorable towards Indonesia given high interest rates in the US. As the US Federal Reserve looks to start to normalize its policy rate, there is room for Bank Indonesia to start cutting its policy rate towards the fourth quarter of this year. However, it is a waiting game for BI at this stage because we think that further rate hikes in order to keep the interest rate differentials attractive from Bank Indonesia are hitting its limits. At the same time, BI has taken a multi-pronged approach to supporting growth by keeping the reserve requirements ratios slightly looser and providing supportive macroprudential policies in order to enable credit growth. To that extent, we do believe that at some point, Bank Indonesia will need to synchronize both the policy rate and the macroprudential policies into one comprehensive stance, and we expect that to be an easing bias coming in 2025. Overall, our story for Indonesia is that beyond the cyclical slowdown this year, we do expect that growth will pick up over the medium term. That said, there are still some concerns as to how President-elect Prabowo will navigate the fiscal conservatism that has dominated the headlines in recent days, putting some downside pressure on the currency as well as on sentiment. It will be crucial for President-elect Prabowo to navigate this cusp of change in a delicate and convincing manner to keep investors on his side. Moving on to Malaysia, things are looking up. When we started the year, we were cautiously optimistic on the growth front as well as on the fiscal consolidation front. On both of these, we are seeing more ticks than crosses. Specifically, in terms of growth momentum, it has picked up. Q1 GDP growth improved to 4.2% versus 3.6% in 2023. The improvement was broad-based across exports as well as domestic demand. Specifically, investment spending and household spending contributed well to headline GDP growth, suggesting that all engines on the economic growth front have started to fire. Importantly, the policy mix is turning more conducive not just for growth but also in terms of supporting investor sentiment. The government has followed through with fiscal consolidation in terms of electricity subsidies in January of 2024, as well as retail diesel subsidies in June 2024. Retail diesel prices were increased by more than 55% on the 10th of June, which the government estimates will save about 4 billion ringgit in terms of annual expenditures. For this year specifically, we estimate that the prorated fiscal savings will be around 0.2% of GDP. Going forward, the government remains on track to achieve its fiscal deficit target of about 4.3% of GDP in 2024 versus 5% of GDP in 2023. Our estimates suggest that fiscal consolidation is on track of about 0.5% of GDP. The remaining 0.2% of GDP will need to be made up in the coming months. More importantly, the government has also managed to mitigate MYR depreciation pressures in a more convincing manner. In 2023, ringgit depreciation was top of mind as a concern for investors across the board. Starting in late February of 2024, BNM as well as the government has put in place concrete measures to address MYR depreciation pressures. First, they are working closely with GLCs and GLICs to help repatriate and convert foreign currency earnings into ringgit. Second, FDI and portfolio outflows are being calibrated in order to mitigate MYR depreciation pressures. Overall, these measures have been working, and we've seen the ringgit actually outperform regional peers. Going forward, we do think that ringgit stability will remain a priority for the government as well as Bank Negara Malaysia. For BNM, the other consideration is inflationary pressures. Despite the fact that we've seen some fiscal measures coming in, inflationary pressures remain relatively well contained. BNM estimates that headline inflation will be within the range of 2 to 3.5% in 2024. Our own forecast is for headline inflation to average about 2.5%. Given benign inflation year to May, we do see our overall 2024 inflationary forecast as being quite achievable. For BNM, in terms of the policy rate, we do not expect any changes. This is to say that even when the US Federal Reserve embarks on a rate-cutting journey, we do not think that BNM will follow suit. The 3% current policy rate is fairly neutral for BNM and is consistent with growth and inflation targets. As such, for Malaysia, the economic story has turned more positive in 2024 compared to 2023. Apart from growth, inflation and fiscal policy, the government has also been quite proactive in attracting FDI into the country. Prime Minister Anwar has been mobilizing FDI across various parts of the globe, including Germany as well as in the Middle East. We do think that ultimately Malaysia is well poised to attract further FDI inflows from not just neighboring countries such as China, but from other countries as well, including Europe.